Welcome to Money Matters with Greg, where we dive into the money conversations shaping your life. From investments to estate planning, insurance to taxes, we cover it all with a fresh perspective. Join Greg and his guests each week to get inspired and take control of your financial future. Let's get started. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.
All right, welcome to another episode of Money Matters with Greg. I'm Greg Farrall, CEO and president of Farrall Wealth. It's a wealth management firm that's located in the charming town of Valparaiso, Indiana, just outside Chicago, in the northwestern corner of Indiana, in the Midwest. And we service clients not only around here and in this area, Chicago, Indianapolis, but also in 21 states nationwide. We've got clients all over. We work with a lot of high net worth, ultra high net worth families and their businesses. And we try to bring some of the things that we talk to those clients about and ideas about everything from estate planning to investing to debt to you name it in regards to anything to do with money. And try to bring those conversations to you here as an audience. We podcast on Apple and anywhere you pod, really, Spotify, you name it. And then also we broadcast on WVLP 103.1 FM locally here. It's a great radio station, and we're really proud to be a part of that as well. So listen to us on Thursdays at 1 o'clock and then replayed on Saturdays as well. And it's usually about a half an hour event. And that's what we wanted to do today, was talk about some of the things that affect your money. Many things in this life do. You've seen in this world the recent inflation numbers have been intolerable, honestly, as far as costs go. Just going to get a dozen eggs cost over $4, close to $5, maybe even $6. So there's some things that have certainly changed. And one of the things that I wanted to be able to bring up today was much of what that has to do with is overall debt of our nation. It's obviously a very big talking point right now. It's in the news quite often. And I wanted to be able to kind of fill everybody in on exactly what is coming in refinancing the zero interest rates policy that once was. Before I start that, I want to go in to just make sure that everyone knows that the opinions voiced in this podcast and on this radio show are for general information only and are intended to provide specific advice or not intended to provide specific advice or recommendations for any individuals. To determine which strategies or investments are maybe suitable for you, please consult the appropriate qualified professional prior to making a decision. All right, now that I've done the house cleaning in regards to making compliance happy and read that disclaimer, just want to be able to talk about refinancing the ZIRP, which is the zero interest rate policy of the Federal Reserve. And since the shift that actually happened from zero interest rate, that coincides with the substantial $7.5 trillion refinancing cycle, where markets are really preparing to kind of like for another round of debt ceiling negotiations. There's a lot of risk here going on. And a lot of this report and this conversation is from LPL's research that we have access to. And you can find this on our website at farrallwealth.com. A lot of this research comes from Lawrence Gilliam, who's the CFA and Chief Fixed Income Strategist for LPL Financial. And that's really where I wanted to be able to pull from and just kind of bring to you as about what's out there and the risks that are involved because it's in the headlines. I mean, we're talking about debt, obviously with the DOGE and many of the things that they're finding as far as being able to eliminate some of the expenses and lower on a fiscal side, the overall budget. What about the past, and how does that look as far as what we're looking for? Right now, as far as an investor goes, your yields on treasuries are pretty good. I mean, they're above four across the board. Much of the curve that is, near term to long term, really offer attractive risk-free returns. And obviously, careful security selection is warranted, but investors, they might consider, avoiding maturities or T-bills maturing around the debt ceiling deadlines that might be very volatile. But there are opportunities there to get a sort of yield that exists right now that isn't so bad. It's certainly better than what it has been in the past. But let me just talk a little bit about the debt load that is current. So, um, as I said, there's no secret here, and it's not new to anyone who's turned on the evening news lately, that America has a debt problem, especially of late. The U.S. federal debt load has followed an increasingly steep trajectory over the past few decades. But post-COVID-19 era really marked the unprecedented acceleration that was just absolutely insane. Um, Debt grew steadily from around 5 trillion in 1996 to approximately 20 trillion in 2020. And the pandemic triggered an extraordinary surge, pushing the total to be more than $36 trillion. So the COVID-19 pandemic really necessitated the massive government spending across many various measures. And these were including stimulus checks, if you remember, enhanced unemployment benefits, business support programs, healthcare expenditures, the coronavirus aid relief and economic security, or the CARES Act, if we can remember, and that was just a little while ago. There were substantial relief packages trying to prevent a crucial economic collapse. They added millions to the federal debt, trillions to the federal debt in a matter of months. And this emergency spending, combined with decreased tax revenue due to reduced economic activity because no one was working during the lockdowns, created this perfect storm of debt accumulation. Now, what's really concerning is that even after the immediate crisis passed, the debt has continued to grow rapidly, and this suggests really structural issues in federal spending and revenue collection that extend beyond emergency pandemic measures. And the post-COVID-19 has brought new challenges, including inflation pressures, interest rates, and increased cost to service that debt, which is a whole nother conversation and why I bring this up. But the implication of the debt trajectory is really significant. And with higher interest rates ultimately increasing the cost of servicing the debt, it's only getting worse. According to the Congressional Budget Office, or the CBO, net interest payments are set to make up nearly a quarter of all federal outlays in 2050, and that rises from the 13% that's currently. So, scary things are coming if things aren't fixed here. But while total debt loads are headed to over 160% of gross domestic product, or GDP, over that same period, that's really the scariest thing for us as far as we start looking at this, um, and where we look forward now. Debt load suggests that without some sort of significant policy change, and it's going to continue to grow, and the steepening of the curve really indicates an accelerating pace of debt accumulation, and all of this can be extremely difficult to manage. So what's looming in the future? That's the past. It is what it is. Let's figure out, I always talk about, in life and with money matters for sure. When you drive a car, you always look through the windshield, and in life, it's always good to look through the windshield, not look at the rear view mirror. Unfortunately, in this situation, you really have to consider what the rear view mirror looks like and what exactly is behind us. But what about the looming Treasury maturity wall that's coming? And this is a $7.5 trillion problem. Um, and before we get to that, just want to be able to mention this is a podcast that's on really wherever you pod, but also WVLP 103.1 FM station identification. We are very flattered to be on WVLP's programming that shows Money Matters with Greg. I'm Greg Farrell, CEO and President of Farrall Wealth. And today we're talking about the debt of America. And this $7.5 trillion existing coupon debt, it needs to be refinanced. And this marks the largest refinancing cycles in U.S. history that's coming now with a weighted average coupon rate on existing debt around 2.75%. Current market rates would be between 4 and 4.5. This shift really represents the substantial change of government financing cost. The expected increase in interest payments between 94 and $131 billion annually reflects a broader normalization of interest rates following the zero interest rate era. And while current yields reflect general concerns about Treasury supply, we may not have seen the full impact of the refinancing cycle in the curve, and that's why I bring it up today. Especially if the Treasury Department decides to extend the maturity profile of this debt. Although just last week, Treasury Secretary Scott Bessent said those actions were a quote unquote long way off. I'm here to tell you it's not that far off. So with the size of this wall, combined with the rate differential between maturing debt and new debt, it really is a structural shift. And for investors, the environment creates really interesting opportunities. While higher borrowing rates aren't great for the U.S. government, Treasury yields at levels that we haven't seen in over a decade at least really do offer those risk-free returns I was mentioning earlier. So it is something to consider. You want to be careful with when you ultimately would buy treasuries, and especially as we talk about the government spending ceiling that could be raised. So, what about that? The debt ceiling, here we go again. All right. This just seems to be a never-ending thing in certainly our lifetimes. But refinancing situation is a potential concern coming up here over the next few years, and the ongoing debt ceiling debate is always starting to creep into market pricing. But the Treasury market's already showing signs of stress about this as a potential July and August debt ceiling showdown between the parties. Now, since 1960, Congress has acted 78 times to raise, extend, or revise the debt ceiling. Now, 49 times under Republican presidents and 29 times under Democratic presidents. Now, despite this long history of eventual sort of resolution, each confrontation creates unnecessary market turbulence for sure, and it costs, and the cost to taxpayers. The 2011 standoff, if you remember, would it really led to the U.S. losing its AAA credit rating from the S&P, and the 2023 episode, which was the Fitch downgrade, which is the rating system, both demonstrated how these political battles really can rattle financial markets and increase government borrowing cost. even after a resolution. But crazy times are coming. It's on the way. So here it is, February of the year, trying to talk about what's coming in July and August and what could rattle the market. So the current market's pricing suggests that investors are treating a late July, early August as potential X date, to the point at which the treasuries would exhaust extraordinary measures without congressional action. So we'll see, but the bills maturing during the period are yielding between 4.35 treasury bills, 4.35, 4.38, and those are higher than those surrounding maturities. So that indicates a risk premium. So it's really something to watch. And given the political environment, the narrow House majority, markets appear to sort of be bracing for another round of this brinkmanship, even through the history suggests that Congress will ultimately prevent the default. But the bond market, a nervous bond market does not a good market make. So ultimately, in conclusion, as we talk about this, debt crisis and debt concern here in America is, the Treasury market is adapting to several developments. A major refinancing cycle, right? So, what are we going to do in the refinancing side? The normalization of interest rates following this zero interest rates era, and the ongoing the debt ceiling discussions that are concerning. Now, even though Congress has successfully addressed the debt ceiling 78 times since 1960, it's going to be interesting to see what kind of resolution, the politics and the political debate can be able to figure out. Now, the refinancing of the 7.5 trillion in debt or higher interest rates will increase interest cost by 94 to 131 billion dollars. And this represents just a natural consequence of monetary policy normalization rather than a crisis, and going from zero interest rates to higher interest rates, which we've done and we've needed to do. Like free money was in existence for a really long time, and gone are the days of 2% interest rates and two and a quarter and three on your mortgage. Um, and rightly so. Like, we cannot sustain that type of interest rate number, no country can. Ultimately, it just fuels an economy that moves way too fast, and then you get inflation, which we're finding out today. So living that dream. The market's resilience really through the past transitions has been pretty amazing in these evolving conditions. And even as uh, investors really try to adapt to this new interest rate environment, but all of these changes really need and require an ongoing attention from the policymakers and the market participants alike. But they also represent these manageable challenges within, if you have an established fiscal and monetary framework from the Fed to Congress, and how this looks, this is what's coming. So I just wanted to be able to talk about it again. I'm Greg Farrell, CEO and president of Farrell Wealth. The show's Money Matters with Greg. We talk money on this show, how it affects your life in the daily and also long-term developments. Today, I just wanted to talk about the overall debt because it is in the news and it should be, and it will stay in the news, certainly all the way through the summer of 2025. So we'll be watching. And if you have any questions, please email me at greg@farrellwealth.com. It's like Will Ferrell, but he spells it wrong. You can see up here, it's Farrall. We do broadcast this show on YouTube and our YouTube channel at Farrell Wealth. We're also on all socials, Twitter, LinkedIn, Facebook, and Instagram at Farrell Wealth. So thanks again to WVLP for having us on board, WVLP 103.1. We broadcast on Thursdays at 1 o'clock and then again on Saturdays as a replay. So thanks again, everybody. And I hope this was some sort of help in bringing you some clarity on exactly what the debt is here in America. Thanks again. We'll talk to you next week. See ya.
It's today. Remember, your financial journey is personal, but you don't have to go it alone. If you enjoyed the show, be sure to subscribe and share. Until next time, here's to making your money work for you. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.